presentation, rolling through Team D and Nike. So you guys go when you're ready. Oh, I forget every time. Thomas, that's sitting in the back of the room, will let you know we have 1 minute left in your presentation period, and he'll also let you know when Q&A has a minute left.
Thank you.
Keep forgetting that.
Good afternoon, everyone. Thank you so much for having us today. We're going to be pitching Nike as a buy. But one thing we want to make clear before we get started is that Nike has faced some short-term headwinds over the past couple of years. We believe that the company has strong fundamentals, and we believe there's a really strong turnaround story for Nike. So now getting started into the presentation agenda, we're going to start with our industry overview, then our company overview, move into our 3 main thesis points, look at risks and catalysts for the company, then our valuation and financial model. So now starting with the industry overview, Nike operates within the athletic industry, which is a very broad industry, but the 4 major subsegments are footwear, apparel, equipment, and accessories. Now, the industry has been growing steadily over the past 3 years. It's valued at about $430 billion with a 6% compound annual growth rate, and about 35% of that coming from the North American market. Now moving on to the competitive landscape, the 3 major companies that Nike competes with is first Adidas, which makes about half the revenue that Nike does, and they have a major focus on footwear just like Nike, and then Under Armour and Puma coming in a little bit smaller and having more focus on apparel. Now looking at the relative valuation metrics, Nike currently sits below Adidas, which is trading really high, as a current PE of about 20, and then their EBITDA is right around 30. Now moving on to the company overview. So like we said, Nike operates within the athletic industry. It was founded in 1964, first focusing on very specialized running shoes. But since then, they've signed major athletes like Michael Jordan, and has really grown their business to a worldwide sort of market with a focus beyond footwear and more in the apparel space as well. Now, their revenue has faced some headwinds in the past couple of years because of some headwinds from implementations that the old CEO had. We'll get into more specifics later of what that sort of story of the comeback looks like. So I'm moving on to their operating segments. So they simply just split it up by geographical region, with about 50% of their revenue coming from the North American market. That's really started their business, really grew it, but there's been a lot more growth within the other areas as well. Now looking at the management transition, so one of the key things that we believe makes Nike such a good company right now to buy, their old CEO, John Donahoe, came from a tech background. He tried to run Nike like a tech company, which really didn't work well for them. So they reinstated Elliott Hill back into the company. He started as a summer intern, left the company, but then was put back in place as CEO. He has a strong fundamental foundation of what makes Nike so great, and he's really going to be able to bring the company back to what it once was. And then we can see some other additional executive team members that are right now.
So that being said, let's talk about our thesis points. So the first thesis is focusing more about how we believe Nike's move back to wholesale, which the CEO is focusing on, is going to be extremely beneficial to them. So as you can see, Nike historically has always been a wholesale-driven company. They want to make sure the shoes are in front of people. And recently, when the new CEO came, like I said, ex-new CEO came, he, as mentioned before, he ran a company like a tech company, got a new app, treated like eBay because he was from eBay, and that basically led to Nike to kind of value and go with. But as lockdown ended and people started shopping again, Nike shoes were nowhere to be found. Because of that, we started losing market share, and of course, we had some supply chain issues. But overall, the loss in wholesale market share really impacted the top line and therefore the bottom line as well. And the new CEO's goal going ahead is to bring Nike back to that wholesale strategy that initially was dominating it. With that, going ahead, we now have a omnichannel strategy. Essentially, we have 3 different ways of distributing revenue. We have an EPC segment, which the old CEO kind of almost founded for us or redid for us. We also have the wholesale segment, which we have been dominating it, and we have our 9 locations. And we believe that the new CEOs focus on innovation and improvement, and these 3 different strategies of revenue is really going to be beneficial to our top line and bottom line over a long-term growth potential.
Our next thesis point touches on how the company maintains a competitive advantage in an oversaturated industry. And so jumping into it, the first thing to note is that Nike's products are created by athletes, for athletes, but also for everybody else. As you see on the bottom of the screen, their consumer perception of these products is extremely good compared to other competition. They also partner with specific companies targeted at specific demographics. A great example of this is Nike Skims, one of the recent partnerships targeted at consumers looking for comfortable products. And so they really target based on those specific consumer demographics. They do this through really innovative marketing strategies that don't focus as much on the product, rather focus more on the image of the company. So moving forward, I wanted to show on this graph here, Nike provides footwear solutions for all types of consumers, both in their male and female, as well as children categories, and across all different rigors of wellness and as far as use. And so, for example, there's a shoe for an advanced runner who needs something more technical, but also for the everyday consumer. Moving forward, I wanted to talk more about Nike's competitive advantage. It's a very organic advantage they have that's inherently based on the products. So, for example, their products have better monetary value, better quality, but more than that, it's the partnerships the company has. So, they partner in 3 separate areas. The first with direct athletes, as mentioned earlier, with Michael Jordan, other name brand athletes. They also partner with leagues, so long-term partnerships with the NFL and other major sports leagues, as well as specific events like the Olympics and the World Cup. And then finally, with other companies, so the Nike Apple Watch partnership historically is one of their most successful partnerships, continuing to generate brand awareness for their company.
Thank you. Our final basis point is going to touch on Nike's marketing strategy and their engagement with customers in a holistic manner. The first thing to note is that Nike spends much less on marketing as a percentage of their revenue than their competitors. So they're spending about 8% of their revenue on marketing, and this is compared to their competitors at about 9.5% to about 12%. And so the big picture idea to understand here is that Nike gets more bang for their buck on their marketing spend. And this comes through a variety of platforms that the company has to allow customers to continue engaging with the brand even after they make an initial purchase. And we can see very real outputs from this marketing strategy. When customers use these strategies, they're more likely to spend, and they're more likely to spend more. And so Nike can really stretch out that engagement with their customer. And moving on, this isn't just limited to shoes. We've touched on the variety of their product offerings before. And this is true also of their apparel and their equipment revenues. So within these revenue segments, Nike has products for very comfortable, very casual products like quarter zips, but they also have products for very specialized use cases. And both of these segments have also continued to grow well since 2020. And now we will touch on to our risks and catalysts.
So first, touching on some catalysts the company has. The first is growth in the athleisure space. This is a specific area of athletic clothing that's really becoming popular among younger demographics. The next is with a supply chain that's extremely complicated with everything going on in the world, they're really trying to expand margins and build a comprehensive supply chain through strategic investments. The next is this point being the global marketplace. And so they're really capitalizing on areas like China, for example, with a growing middle class, spending more on footwear and related items. They're trying to capitalize on that global presence they have as a company. And then finally, the brand awareness. As we talked about throughout the presentation, Nike's partnerships put them at the forefront of this industry, and they continue to leverage those partnerships to be at the front of the industry compared to competitors. Now, to talk about some risks, there's a few that are on the screen. I'll obviously address the elephant in the room first, and everything going on recently with tariffs and trade policy that does impact Nike, just like impacts any company focused on consumer discretionary spending. All of Nike's competitors also rely on that spending. And so our pitch today is really that Nike, relative to those other companies, is still set up for success based on the thesis points we've discussed moving forward. Even though this impacts them as well as all their competitors, we believe that going forward, Nike's positions well to really combat this situation one of these short-term benefits.
With that, let's run through the company performance, company stock price performance. As you can see, this over here highlights the company stocks since 2020, essentially since when the company's downfall kind of began. So the first big hit was in Q1 of 2023, when Nike missed its initial sales estimates. This happened because of a combined reason of supply chain and inventory management issues. And since then, Nike stock hasn't gone on a downward slope until the new CEO got in and announced his turnaround plans. Since then, the stock has flatlined. However, of course, there has been some level of volatility due to the overall market sentiment. With that, this shows our price targets versus the street. So as we can see, Wall Street has a lot more of a dispersed price target, with the lowest price target being roughly $50 a share, and the highest being $120, with the model being around 50 and 90, with the price target being 73, which we will speak about now. So as you can see, the target price here is 73. We came to the target price using 3 different valuation methodologies: EBITDA, price to earnings, and discount cash flow. From the current close of roughly $59 a share, we see upside of roughly 20% on the stock going forward.
So here we have our scenario analysis. There are 2 major things to note off the bat. First, with respect to our upside and downside, it's a very asymmetric distribution. So the company is trading much lower than it has really in a long time, and we we see a real potential for upside, even with our bull case, and that is a big upside, but it's important to note that that price target is well within the company's 52-week trading range. So the company absolutely has the capacity to hit even our bull case estimates. These valuations are dependent upon the company's ability to execute on internal factors as well as their impact by external factors like tariffs and trade policy and discretionary spending and whatnot. Looking into our sensitivity analysis, at the top of the screen you can see our model drivers for both our DCF model and our multiples model, and on the bottom we have a sensitivity analysis that shows a price target for both models around $73. Finally, this is a simulation analysis. So we ran 100,000 simulations through our financial model with a variety of outcomes, revenue growth rates, different margins, different conversion cycles, different WACs and terminal growth rates. And we found that within our model, around 94% of the time, our valuation was greater than the current share price. So again, this is really reinforcing the idea that there really is an asymmetric return potential for Nike. And with that, I'd like to open it to questions.
Is this a revenue story or margin story?
I think it's a mix of both. So I think initially it's revenue, because the biggest hit that we've seen has been revenue. And that's mainly because we lost that market share, right? When lockdown ended, when I go to, let's say, Foot Locker, I go to Dick's, I can't find Nike, I find On, I find Program, and Adidas around about Nike. The reason for that is because they will continue to DTC on their app. And so the inventory with the wholesalers does not exist because that revenue has taken a hit. And we expect another hit this year for FY25, which is this May, that's when the fiscal ends. And so we believe that a big driver for us is that return to wholesale and return of revenue growth going ahead.
And then, well, okay, so if this, back on the revenue and the loss of market share, your modeling this out will give you confidence that they're going to regain market share, take market share. What's the dynamic? Other than having a new CEO, they're like a big marketing campaign, they got a fancy new sneaker coming out, help me understand.
Sure, I can take that. I think there's one thing really that's important to note here, and that is that before this CEO made the changes and run them like a tech company, as we talked about, which is that D2C model, they had very strong partnerships and had that large market share because of those partnerships. So the new CEO is coming in, they're rebuilding those partnerships, historically very strong, and on top of that, maintaining the D2C model and have that omni-channel approach. So through multiple ways of contacting the consumer, we think that that'll help the market share expand what it once was, but also much bigger.
I was wondering if the problem was in some years they didn't spend enough on marketing versus the previous.
I think Nike as a company itself, I think it doesn't really need to spend a lot of marketing just because when it does market, it gets that message through, right? So for a company like me, it's always been about kind of the story and it's kind of been about the kind of what it provides to consumers, and it's not exactly tangible. It's tangible and intangible. It's kind of the story that it provides to consumers, and it's the story that consumers try to be a part of. That makes sense, especially with its partnerships with all different, sports leagues or partnerships like Michael Jordan, Cristiano Ronaldo. I mean, these guys, just these two guys itself, have probably more than 200 million followers on Instagram alone, right? So they wear Nike shoes in all their football games or soccer games, all their basketball games. So that by itself attracts a lot of customers to Nike, and that's kind of the reason why we have such a strong faith in Nike in its turnaround, because that itself, that sentiment from consumers still remains on wholesale or not. It's just that as consumers not able to see it as frequently as they could. I think that's been the shift recently, but I think as we move towards that wholesale, I think it should shift in our opinion.
Yeah, so they've been able to kind of ride on their brand, their mission, and marketing, and understand they are losing market share, which are attributing that to not as being as visible in retail and outlets. How hard is it to reestablish yourself in retail format that shelf space is already been allocated to the brand?
Yeah, I would say it's definitely not as hard to do. I think especially the thing with Nike is that it's not just that they're going to be coming back to these wholesale distributors for the first time. They had a long time history with them. That's where they grew a lot of their business originally, and that ultimately does drive a lot of sales to these wholesale distributors. So I think if they're able to come back to them, originally they just left them without sort of, a way to, they just wanted to focus on their D2C easy without really focusing on wholesale. So for them coming back to those wholesale distributors, it's just because it's not the first time, they've already seen a lot of growth. Those wholesalers have seen a lot of growth because of those Nike products that they have in the stores.
And kind of add on to that, the big reason why the next year was fired by the management is because he did a really poor job handling that relationship. So management realized that, shareholders realized that relationship with wholesalers is extremely crucial. So since they picked him out, the biggest focus for Nike has been to get that relationship back, and considering the amount of business we can provide these wholesalers with new improvements, innovation, the recent partnership with Skims is extremely valuable to these wholesalers. So that's been an attraction point for them to get Nike back to its source.
So if I buy my Nikes either at Dick's or Amazon, there's Nike here, there's a wholesaler in the middle, and then there's those companies.
Yeah.
Who are the wholesalers? I've never heard of a single one.
So that could be Dick's Sporting Goods, that could be.
Well, they're the retail.
Yeah.
Okay, who's the wholesaler?
They are, yeah, it's JD's, Dick's, but they all kind of play that role.
So they buy.
Right, the retailers.
Yeah. So that they buy a bunch of products from Nike at a discounted price and then be able to sell those wholesale through the physical stores.
Yeah, got it.
So, should we, by analogy, the assumption that the new former CEO is going to be able to gain traction with this new strategy, or should we wait to see if he goes and he's able to get that?
I think it's a great question. I think that the company's current share price is very attractive, especially from a long-term perspective. And I think the bulk of our argument is really structured around the company has a demonstrated capacity to achieve what we're talking about. We're not saying that they're going to reach the moon. We're talking about them regaining what we know that they're already good at. So I think this is really a foundational approach. And again, I think their current share price is a very attractive valuation.
Yeah, I mean, this was a company that traded at like 100, 120 bucks for probably 5 years, and then the past 2 years, you've seen a 60% drop in that price. And historically, we saw this, we looked at the chart of 1980, 1990, and this same thing has happened to them several times in the past. So and they have successfully always recovered, so that kind of also additionally gives us marginal confidence that considering all the situations we're going to be able to have that recovery. So it's time out.